Hey guys, what's up? Stock Retail coming back to you. Happy Sunday, or whatever day you're watching this on. Happy post AMC earnings. It was really great earnings. We're going to walk that through. Something I posted on Twitter as kind of a preview is I like to let the numbers tell the story. We can get out of opinion and we can get down into facts, and we're going to do that today. And I think the numbers tell a really great story today. Speaking of which, you can see we had our best June ever on a number called EBITDA. So we'll talk that through a little bit. Just wild to see in a 104-year history, AMC had its best June ever. So that is a great sign that things have been turning around post-strike. Why don't we just dive into the numbers? I'm going to talk this through. I know sometimes the earnings reviews, it's heavy numbers, but what I really hope you'll do is stick around because couple things. One is I mentioned the numbers are going to tell a really good story and give you really deep insight onto how your management team is leading this company. And the other is for many of you, this will continue to be really good learning on how to look at the financials of a company, how to understand the direction of a company and how its management team is doing. So we're going to go through the numbers, and in a way, this can be like a little bit of a business class, I hope. If you're new here, I say this a lot, but I try to fly by it so that people who followed me a while don't have to keep hearing it and get sick of it. But I do have 2 master's degrees in business. So when I say, we can talk through and learn a little bit about how to look at business, I have some experience in that. That's all. Okay, so and then one more thing as we go through, just housekeeping. Some of you know I'm coming off a pretty bad kind of chest virus, and so I apologize if I clear my throat a few times today. I got to figure out how to have a mute button on this microphone, but we'll get through, and I'm getting better, so hopefully not too bad today. What I want to just start out before we dive deep into the earnings numbers themselves is just continue to ground ourselves in what happened this quarter. Because, I had mentioned in some videos, and if you follow me on Twitter, I'd mentioned in a lot of posts, earnings are like a rear view mirror. Adam even used that phrase as well. So he and I are thinking about this very similarly, I can tell. He closed the earnings call. If you go back and listen to it, by the way, it's on the AMC website. You can go hear these guys from their own mouths. I encourage that a lot. Like I do a live tweet recap, kind of take notes as they do the earnings call, but I always say far better to get it from Adam and Sean and team than from me. So I encourage you, if you haven't listened to the earnings call, you can go to the AMC website. It was recorded. There's a webcast of it. You can go listen to it and hear everything I'm going to tell you, but you can hear it from them, which is great. But I'll give you one person's point of view as we walk through this. So the thing is, because it's that rear view mirror, so like here we are in August, and we're talking about results that were even partly from April. So a quarter includes 3 months, right? It's a quarter of the year. And if you combine those 3 months, you get a blended result. But I want you to see, first off, let's just look at each month's domestic box office. So you can see April was only a little over 400 million. And then you had May was about 550 million. And then we jump in June to almost $1 billion. So you can see the radical difference that from the beginning of the quarter to the end of the quarter. Those first 2 months were heavily strike impacted, and that's what I've been warning you about for a long time. Made videos last fall, through the spring I was making videos showing you what the strike did to us and when it would end. And the great news is it's ended. We're kind of out of the woods. We're in a much better place now. But you need to know that as those earnings were released, and we got trolled hard. I saw even some old accounts that used to come at us in 2021 kind of came out from under their rocks and came at us and said, what terrible numbers. But when you understand the actual industry, where it was in Q2 and where it now is in Q3, you're going to see some really, really positive, bright spots. And we're going to go through that. So the first thing you need to know, so you can see April was cut by more than half versus last year. That is a heavy, heavy strike impact. Take half of the entire business away, anybody's going to struggle. But what I want you to just know is a business person will look at that and say, well, that's a one-time event, and it's done. I know some folks tried to troll you on, when Adam was selling some shares, he's killing the squeeze and all that kind of stuff. Well, what he really did is he made sure we didn't go bankrupt. He brought in the cash. Remember, survive then thrive. I had videos that talked about that. And now you can just really see clearly why. When you lose half your business for the month of April and you lose about a third of your business versus the last year for the month of May, that's some heavy, heavy strike impacts. That is I don't know, $700 million of the box office just kind of gone. It's like take away last May from that quarter. That would have been a rough quarter, right? And that's what happened. Um, but you can see we kind of got back. But interesting because I just told you, and you can see at the bottom here, June was actually still down versus last year, and yet our results were far better. Now, Adam made it clear he's not going to get in the habit of reporting monthly results, but I really, really appreciate and just value that he did that for us. Because if you heard him on the call and you heard me before the call, I think both of us again had the point of view that it's almost like two different things were happening, two different realities. The first 2 months, you can just see here visually, we lived in a strike impacted reality, and Adam and team had to manage us through that, and they did a great job. Now you can see then June was a whole different reality, far better. Um, and what's really great is, even though the box office was down, we actually beat last year. So let's talk about that a little bit. I want to show you the whole history of June. So if you looked at the earnings press release, you can go find that on the AMC website as well. Or if you saw the news or you heard Adam talk about it, pardon me. AMC had its best ever. It's called EBITDA. So that's not the bottom line. It's earnings before. So you can hear that before word. So there's some other expenses that aren't counted yet. Earnings before interest, depreciation, taxes, and amortization. IDTA. That's the earnings before IDTA. EBITDA. I did that backwards. I did the D before the T, but you get it. So there's a few expenses that you can look at, and in a way, it's because those aren't really operating expenses. That's why you kind of take those out. For instance, depreciation and amortization, the D and the A, those are not even cash expenses. Those don't take cash out of your pocket. It just writes down your earnings so that you have less taxes to pay. So EBITDA is kind of a way to measure how the actual operations are doing, and then there's something called net income, or sometimes we call that earnings. The bottom line, which it does matter, and I'm going to talk about that a little bit today too. So both matter. But so the point is, Adam and team shared with you that in the 104 year history of June for AMC, this was the all-time best EBITDA. And so that's where I'm saying I just really appreciate that he shared that with us because it demonstrated very clearly. Let me go back. We have come out of this strike season, and June was setting all-time records. And so now I want to show you the context of these guys setting all-time records. Here are all the box offices for June, going back to 2008, just because that's what I could fit on the screen. Now I want you to look how many months in June, how many Junes were actually bigger box offices than now. We have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. And there's actually, if I could show you farther down, I think it's 2004. This source, by the way, is Box Office Mojo. You can go check this. There's another year, I think it's 2004, where June was bigger. So now I want you to think about that. This was only the 16th biggest June at the box office. And yet it was AMC's best ever June. Anybody who has studied financials or understands business is immediately going to jump in their brain to say, whoa, this management team has found some operating leverage. And we're going to talk about that term. Adam mentioned that term in the call. And before the call, I had just, I don't know, dumb luck or something, or again, maybe Adam and I are both thinking of some of the same things. I had tweeted at you something about gross to net. And gross to net and operating leverage are a little bit in the same ballpark of concepts. It's, can you kind of cut your expenses while you're raising your revenues? Can you make more money even if you're making, if your industry doesn't necessarily grow, but you still can make more money? So they have found ways, and it's not just cutting expenses, by the way. We're going to show there's some multipliers these guys have found too. Like for instance, we know that we're making way more per person on food and beverage than we used to. So just even another person coming in, if you're bringing in more money, but you're not necessarily having to have more employees to serve that person. It's the same person who came in, say, 2019 and they came now, you have the same amount of employees serving them. Your expenses aren't really going up, and yet your revenues are going up. So there's a lot of multipliers both on the revenue side and then some efficiencies on the expense side that this team has found. So let's pull back up and just say, and you just say it out loud, it's only the 16th biggest June at the domestic box office. That's not very impressive, is it? 16th place. And yet it's the best EBITDA in the month of June ever for AMC. That is how your management team is doing. So that's just one thing I want you to really, really understand. And I had tweeted that on Friday because I caught this. Um, Unfortunately, I think I tweeted the July box office picture, but you still get the idea. The things I said in the tweet were correct. This was the 16th best ever June, and yet the best ever in terms of AMC's profits. That ought to tell you where the company is going. Now I want you to think, what would happen if June had been like 2015 or 2018 here or something like that? How much more profits we would have made. So this is also pointing to you something that we're going to see through the rest of the earnings. And like I said, hang with me because you're going to understand really deeply the direction of this company. Or someone told me just today, yesterday, they DM'd me and said, actually, I pointed a friend of mine to a couple of your sort of numbers videos and now they're all in. Like when you can analyze the company and not just hear people either trashing it or pumping it, just based on trust me, bro, and opinion and stuff, and you can actually look at the numbers and the numbers tell you something good is happening, that should give you a ton of confidence. So I really want you to take the time to understand this stuff. And we're going to point to in a minute, as we go through this, how much this company is set. I mean, when Adam says thrive, it's like we need an even bigger word. We're about to do really, really, really well. So let's keep going. This is something I show you every quarter. I have done this since you could find a Reddit post with the first one of these. So the first one of these I ever did, I put on Reddit, I don't know, end of 2021, I think. And I used to call this the FUD Buster. What it really is a bit of a, pardon me, a bit of a balanced scorecard. And this should teach you a little bit about some things to look at in business as well. So let's go through this and let's see how we're doing. I am measuring, you can just see at the top. Let's look at Q2 versus Q1. Oops, there we go. Q2 versus Q1. And remember everything I just showed you. Remember that first slide. This was a heavily strike impacted box office. So we're also going to have to look at context a little bit and just say, how did AMC do versus the industry? If the industry is kind of the box office, how's AMC doing in context? And then how did we do versus the last quarter? Now, it's going to be a little bit of an unfair comparison. It's going to make things look kind of good because Q1 was even a worse strike impact, right? So what we're really going to start wanting to see is Q3 continuing to improve, Q4 continuing to improve, but I can tell that those are coming and we're going to talk about that too. So let's just look at the health of our business. Think of this as a health check. How are our current assets doing? So that's our liquidity, right? I had started measuring that a long time ago because always the thesis from the shorts was you guys are going bankrupt. And our thesis was, heck no, we're not. And we can outweight the shorts, right? That we're still living in that original thesis, only now we're becoming highly profitable. I promise you that's coming. I suppose I said I promise. I can't actually promise that, but I promise you the numbers tell us that it looks like that's going to happen. All right, so right now we ended the quarter with about 1.1 billion in current assets. Now that counts some things like something called accounts receivable. Think of that as customers owe you money. There's something called restricted cash. So if you remember, Adam and the team had said we had like $770 million in cash. So that's why this number is a little different because I'm looking at total current assets. That is 18% up versus the last quarter. So we're actually up in our cash, even though we actually used some cash to pay down debt. So there's been a lot going on by this company. You're going to see that through the numbers too, continuing to pay down debt. And we are highly liquid, especially considering, let's think back through that June. If that was the best June EBITDA in 104 years, you should just hear that June was profitable. And meanwhile, we're sitting on $1 billion in current assets. So if you're making a profit and you have $1 billion of cash, short thesis starts to be real dead, right? So that's the first thing. Let's look at attendance. Obviously, that is a core of our business. So versus last quarter, we were up 7%. That's just kind of June starting to get us out of strike mode. That's what's going on there. In the US, we were up 20% on attendance. Really nice to see those market share gains. The team talked about some market share gains. I think we had a halo effect out of Taylor and Beyonce concerts. Those were put on by AMC. We had the Billie Eilish listening event this quarter. And so I think we just have seen some nice positive momentum in U.S. market share. Now, the team talked about, you'll see on the flip side, we have double digits down on international attendance in the quarter. If you listen to that earnings call, Adam and Sean talked about there is a competitor in the UK who is pricing at like £3 or £4 per ticket. I mean, you think about in the US, we pay like over $11 a ticket often, especially if you're going to IMAX. You might be paying even more than that. The average comes out to a little over $11 a ticket. If you look in the earnings, it's actually in there and you can check that. By the way, all of these numbers I'm sharing with you are easily fact checkable. These are from the earnings filing. So you can go to the SEC website, you can go to AMC's website, you can get the earnings report, you can fact check me on all of this. And I encourage you just to learn how to do that. Guys, I'm sorry for coughing. I'm going to try to hold that at a minimum. Let me take a little sip of water here just a minute. If you hadn't heard, I took the family to Disneyland and caught a bug there, but I was kind of pushing through it. So I think I just pushed too hard and it turned basically into pneumonia. But I am better. I'm doing great. Thanks for hanging with me. Thanks for putting up with this cough a little bit. All right. So there is a UK competitor, and what you should be hearing is they're basically pricing below profitability levels. That is not sustainable. So they, for whatever reason, were doing some deep, deep discounts. That's not a good business model. You don't want to be a discount uh, I don't know, a discount business. I used to lead basically supply chain planning, like demand planning, and determining how much product to buy for about a $2 billion line of business. And this was like 9 categories in 15 countries. And my number one job as a leader in that was to keep us having really high margins, high value sales, and not getting into like a discount business. So this competitor in the UK is stealing our market share, but I'm saying that's temporary. Maybe stealing is a harsh word, but they've offered some steep discounts the last quarter or two. Maybe that was their way of getting through the strike. I don't know. I don't see that continuing. Adam and Sean made it clear that's not continuing. So I am not concerned about this number, but I am committed to showing you guys the real numbers because numbers tell a story. But you get the context that we've got a competitor who's pricing at levels that don't make any sense. £3 or £4 is probably, I'm going to guess, $5 or $6 a ticket. That's just not going to continue, and then we'll get some market share back. So that is actually, in a way, promising because I would think in the future, as the box office is growing and we get to see some, let's call it regrowth or return of some of our market share in the UK in particular, that's going to help speed up our earnings as well. All right. On food and beverage, we had up 15% on net revenue. I measure our bottom line on food and beverage. So because somebody early on, we saw that we were growing really fast on how much people were willing to pay for food and beverage. And somebody had said, well, there's inflation, isn't the cost going up? So I measure after our costs, which also is in the earnings report. So if we're growing let's call it the bottom line of food and beverage, then that is contributing to our earnings. It's called like contribution margin, incremental profit, whatever term you want to use. So we were up versus last quarter, 15% in revenue on food and beverage. Now, I want you to look at something. We were up 7% on attendance, but up 15% on net revenue on food and beverage. And you can see part of that is we grew our margins. That means the food and beverage expenses actually grew slower than the food and beverage revenue. So that's really fantastic. We expanded our margin on food and beverage for the quarter, and people were buying more. So we kind of got a double win there. So you can see that, typically if everything held steady, whatever you grow attendance, then other stuff should grow by that. So I'm just showing you that we outpaced attendance growth, means food and beverage was growing. And they've been offering some really neat offerings, both in food and then in like some of the cocktails and some things like that. So really nice to see some growth there. And you can see that contributed growth from Q1 of almost $40 million at the bottom line. So that's $40 million more profit in Q2 than in Q1. That's nice progress. And keep in mind, all of these things I'm showing you are in that strike impacted quarter, right? So what you continue to hear is, man, what happens when the box office gets even bigger? And I'm just gonna hammer that point home because your business is going in the right direction. All right, so admissions. So that's what, on this attendance, what did people pay for tickets? Now you can see, so we kind of underpaced attendance growth. We only grew by 6.4% on admissions, but you can see we also had some just down 9 cents a ticket. Probably, if it's that strike impact, you're not selling premium priced tickets in April and May, right? So those maybe weren't some of the IMAX. Maybe there were some discount showings. We just didn't have blockbusters out there. So in Q3, I anticipate we're going to see the ticket price go back up. I just have a feeling based on the way our business goes and how many blockbusters we've had, how much IMAX. People wanted to see Twisters and Deadpool and some movies like that in IMAX, and that's going to contribute to some nice ticket sales. But we had growth. Assets versus liabilities. So you'll hear Adam talk about cleaning up the balance sheet. We want to continue to basically see, like when they pay down debt, that's a liability. You're shrinking your liabilities. And as long as we see the balance of assets kind of becoming bigger versus your liabilities, that's a healthier and healthier business. So you can see we went up 3 points from quarter to quarter. Last quarter, we were at about 81%. This quarter, we're at almost 84%. And by the way, I meant to put a note in here, but I believe that was the best asset to liability ratio. In fact, I remember it is since Q4 of 2021. So, and think back in Q4 of 2021, we were still in a COVID impacted environment. Now, we did have Spider-Man that quarter. That was a really good quarter. But what was happening there is Adam had still kind of brought in a ton of cash. We had very high debt, but we had more cash. And so you should be hearing that we're like almost 3 years out past that point, and now in a much better business environment, back to it's the best asset to liability ratio we've had in 10 quarters. So again, moving the right direction, getting healthier. That's a direct result of these guys paying off deferred rent and paying off debt. And so we're getting healthier and healthier. Operating expense as a percent of revenue, really, really important. And so I've kind of even put an asterisk here. I'm going to talk to you about this from quarter to quarter. So it's just as we bring in revenue, can we keep more and more of the revenue? If operating expenses as a percent of revenue go down, then you're keeping more of the profits. And so we improved almost 5 percentage points from quarter to quarter. You can see last quarter, basically 97% of our revenues kind of were matched with operating expenses. But now we were down to 92%. And so, by the way, as the box office grows, you'll see that number go down a lot. Like last Q2 and Q3 of last year when we were profitable, that number was down in the 80s. So that's what I'm showing you here. Last year, that was in the 80s. But what I want to talk to you about too, in fact, why don't we just go there? So at the bottom line here, you can see if you compare to a similar box office, I went and found, so Q2 was like 1.9 billion, I think, at the box office. So I went and found a similar quarter back in Q3 of 2022. The box office was about the same. So you should say, all right, that's basically the same business, right? But look at that quarter, operating expenses were almost 98% of revenue. At the same box office this last quarter, your management team had gotten operating expenses down to 92% of revenue, about a 6-point improvement. And I just did the quick math on that. That basically means if you had gone back and redid Q3 with the way our business is structured now, we would have added $57 million of profits. That they've basically reduced operating expenses by $57 million from the same box office, kind of the same business a couple years ago till now. That's how much they've improved. These guys have been working nonstop, and Adam talked about it in the earnings call, but you just need to let the numbers show you. I'm showing you right now on the same box office, we used to have operating expenses gobble up about 98% of revenues. Now on that box office, we were down to 92%. So when you compare apples to apples, you can start to see what has your management team been doing. That is I just can't express to you how big of an improvement that is in just 2 years, basically taking out $60 million of operating expenses from a similar box office. That sort of box office matters because, again, as we go up in box office, you're going to see this percent shrink. I've told you for years that AMC has a heavily fixed cost model, a high fixed cost model, which means as the box office goes up, some of our expenses do not go up. And that means we're going to become highly profitable. That's been my thesis all along, and it's starting to prove out. But we're going to talk more about that in a bit. So you can just see in the numbers very clearly, if you compare to other quarters with the same box office, we have been tightening up operating expenses. That's what a management team that is doing well is going to get done. So good job to them. Especially in this inflationary environment, that's all the more impressive. Pardon me. Free cash flow. I keep a heavy eye on that. I've shown you this for years. We improved from last quarter by $160 million. Don't be misled. I want to be clear. So we still had negative free cash flow in the quarter, but we improved by $160 million or 33%. So remember, our attendance only grew 7%. The box office, I don't quite remember. Oh, here we go. I actually have a note on this. Free cash flow expansion of 33%. Box office quarter to quarter was only up about 21%. And I'm just letting you know, as the box office grows more, you're going to see this accelerate even faster. So the TLDR on that, the bottom line, the takeaway is big cash flows are coming. I believe we're already cash flow positive. Like June, I'm really, again, thankful Adam talked about June as a month. I believe that was cash flow positive. July was clearly to me as well. And just ongoing quarterly, you're going to start to see some nice numbers on our cash. Okay, something else I measure because we've been tracking cash flow, and I've told you a bit about this, but if you're new here, so accounts payable and accounts receivable, those are balance sheet items. You would find those on the balance sheet. And accounts payable basically means like I put something on a credit card and I owe you. And if I kind of can wait a little bit longer to pay you, I can keep more cash in my bank account because it's like it's on a credit card. It's not cash that went out the door yet, but it's cash I'm going to have to send out. I'm going to have to pay these bills. And then accounts receivable is you owe me. You haven't paid me yet. I don't have the cash from you, but I know I'm getting it soon. That shows up. So accounts payable shows up in your liabilities. Accounts receivable shows up in your current assets. And so what we saw is versus last quarter, accounts payable was up 50 million. We owe people $50 million more. But again, remember, that means that 50 million is cash sitting in our accounts that we haven't had to send out yet. And accounts receivable was only up 16 million. So what that means is, I said accounts receivable down, but if accounts receivable is up less than accounts payable, we got to keep more cash on our side. So this difference between this is basically more cash we got to keep on our side. I like to see that. You don't want to game the system. You want to pay your vendors well. You want to pay them in timely ways. But in general, if we can keep more cash on our side, you guys know that I like that. So that's why this one's green, and just consistently the way I measure it. All right, bottom line. So net loss or gain. You can see we were down 33 million. So that's our earnings. Minus 33 million, but that's $131 million improvement versus the last quarter. And again, on a strike impacted quarter. So imagine if we improved 130 million and we're still strike impacted, how much more we're about to improve as we've kind of come out of the strike. I do want to just call out that 100 million of that was basically attributable to one-time events. So I'm going to show you in a minute here too how we basically made a profit on paying off some of our debt. So they have to account for that. What it really means is we paid less than what we owed. So you count that as profit. And then also there was a lawsuit settlement AMC had. I don't remember the exact number. It was in the teens, maybe 19 million. Don't quote me on that. But anyway, we had a lawsuit settlement that you have to count in our profits as well. So those are one-time events. Those will go away, but that still means the rest of this improvement was just from the business. Okay. I mentioned I want to kind of look versus the industry. Let's just go back real quick. So what I'm just showing you, quarter to quarter, we improved on every single item that I've been measuring for 3 years. We're going the right direction. You know this was heavily strike impacted. So you also know that we're kind of done with some of the drag impact of the strike, and things are about to improve by a ton. All right, so how did we do versus the box office? Because of the strike impact, what I want to know is, look, Adam and team could not control that. So how did they do against what they could control? And again, the numbers tell you a story, so you understand how is my management team doing. So the box office was down almost 30% year over year. Box office was down 28%. On attendance, we were only down 24.5%. So we beat the industry. If the box office was down 28, but our attendance was only down 24, all right, we beat the industry. And that was in spite of this competitor in the UK doing this kind of sort of shady business model that's not going to hold up very long. So great job. We beat the industry. Food and beverage net revenue. again, we beat the industry. We were down 25% on a box office that was down 28%. So they found a way to kind of just think of any amount you beat the box office by is, something that AMC did, um, and recovering some revenues. And then on total revenue, we beat again. So if the box office was down 28%, but our total revenue was only down 23.5%. So the team basically found ways to recover a little bit in spite of the strike. I want to show you a little bit about our debt paydowns. And so I've shown you in the past. I want to say we're probably like, I don't know, 12 out of the last 14 quarters or something like that. Your management team has been paying down debt. It's just consistent over and over and over. I'm going to show you a chart on that in a minute that I've shown you before. Just makes it clear. But if you'll look, you'll see, and this is from the earnings release, the main thing I want to call your attention to a couple things. So there were two ways we paid down debt this quarter. So you can see with cash and with shares. So in one case, we directly gave a lender shares and they basically wrote off or forgave some debt. And in the other case, we had some cash. Now we had cash from selling stocks, but we used that cash to pay down debt. And so one of the things I've told you, we've had a discussion a few times about dilution and value creation. Anytime Adam sells some stock, that is dilution, right? And so shorts and trolls want to really, really focus you on dilution. But you need to remember, okay, well, that generated cash, and what is that cash used for? And a good manager, let's say they bring in $100, but if they use that $100 to create $110 of value, the dilution maybe was the $100. You could figure out basically how much a stock should go down and kind of factor it across all the shares. But if they create more value than the amount of stock they sell, then actually in the end, the result is your stock starts going back up because of that value creation. That needs to get priced into the stock. Now, we are dealing with a heavily, heavily manipulated stock. And I've shown you the math before that you can prove, because there's two things. One is I'm going to show you on this slide how we paid off more debt than what it actually cost. We saved a ton of money. So there's a profit to the balance sheet, basically, and the team captured that. And then what's more is, remember, when you pay off debt, you're supposed to pay interest payments every month. Well, or every quarter, sorry. You're paying these interest payments every quarter, and you can find that in the earnings release. You can find that in what I call the P&L statements, profit and loss, or people just call it the income statement. You'll find interest payments in there. Well, when you pay off debt, you don't owe any interest against that debt. So what's been happening is steady, quarter after quarter after quarter, Adam and team have been reducing how much goes out the door because we're lowering our interest payments. It's just like you guys paying off a credit card and now you don't have interest anymore on that. And so there's kind of a snowball effect to that. The more we pay off, the less expense we have, and then the more cash we're keeping and the more we can pay off. And it starts to snowball itself. And you're going to watch that these next couple years. You're going to see these guys not have to sell shares anymore and start paying off debt with just our profits. And then it's going to just accelerate itself because our expenses will be going down. And so then our profits will be higher, and then they pay off more, and then our expenses go down, and then our profits are higher. And then they see how this keeps going. So I just want to show you, just from this last quarter, you can see with cash, we paid off $145.5 million of debt, right? So let's say that's at about, I don't know, 10 or 11% interest. So you're talking about $15 million a year of interest we no longer have to pay on those. Nice. Really great. Excited to see. Now, that cost us $84 million, and I think because of some accounting rules, we counted that as $87 million of profit. I think that probably has to do with, I don't know, like future interest savings and some things like that. But that was part of some of the profits you saw that these guys counted in the quarter on something called gain on extinguishment. That's basically just reporting profit. But bottom line, you can see, like in this case, we paid off $146 million of debt, but it only cost us $84 million. So that's $60 million that we got savings on our debt. So some lender said, "Man, I really want the cash." Which, by the way, I'd also told you that was coming in a video maybe as far back. That one might even be November of 2022, I think, or December, somewhere back in late 2022. Where I said lenders are going to really want cash because that's where the economy was going. I could see it, right? We're kind of in a liquidity I don't want quite to call it a crisis, but we're getting close to a liquidity crisis. Lenders want cash, and so they'll give Adam a discount and say, hey, if you'll give us cash, we'll forgive your debt by more than the cash you gave us. And that is playing out. So just, I don't know. Another one I want you to hear, something I'm going to talk about, remind you of today is like, who's getting things right? And I got that one right years out. So then there's another lender who we traded $190 million of shares. Sorry, we didn't trade that much shares. We had a gain on that one too. So we had, I don't know, let's say this was at $5 a share. That looks like that's about $135 million, $140 million, somewhere in that zone. But we paid off $190 million of debt with that. So Adam is consistently finding us savings on our debt payments, and then that's translating into future savings on interest. And by the way, normally you'd price in, I've told you guys, like say 15 to 25 years of those interest savings because those are contributing directly to earnings. So you got something called a price to earnings ratio, which means really on these transactions, our stock should be going up. And so maybe I'm going to get off this point, but I'll do something in the future to show you that you can pretty much prove our stock should be going up on these transactions in spite of the dilution because there's so much value creation happening. So that's, again, this management team doing a great job. Just showing you something visually that I've shown you quite a few times. And you can just see, so if last year we had Barbenheimer and Mario and some other stuff, the orange line is the domestic box office. And you can just see strike, bang. But you'll remember, if you've been around a while, the video I did, I think in November of last year, where I showed you this strike impact, and it looks exactly like what's going on. I showed you there was going to be this like trough and that we'd start going back up. And I'm forecasting right now that the next quarter is up here, kind of 2.4 to 2.6 billion. Sorry, the current quarter that we're in right now. So we pop right back up here, only we're more profitable now than even just a year ago. So you're about to see some really nice results. This green line, our revenues, is going to jump back up too. So that's going to be really great. This is on two scales, as you can see. On the left here, there's the revenue. So it's two different numbers. The green line follows these numbers. Orange line here follows these numbers. But the point is, we're popping back up on both, and you're going to see even more profits now than what we used to get on the same box office. The team in that year's time has really, really managed us well. And you can just see, so part of that is our debt. If you looked at rents and if you looked at depreciation and amortization, those are all down as well. So all these expenses are down where revenues are about to go back up. So just say that out loud. Our expenses are down while revenues are about to go back up. That is more profitable, right? And so the shorts don't want you understanding that. They really don't want you knowing that, and they don't want you telling your friends that. But if this is a business where during a hard time, the company has gotten expenses down, as the good time, Adam said the good times are about to roll, as the good times come back, these guys were so diligent and worked so hard that they have now set us up for not just, like if they had sat on this and just sold enough shares to have enough cash, they could have done that, we would have survived, and we'd kind of see some profits. But they've actually worked during some pretty dark times for the industry to actually fight so that now as the industry recovers, things are even better than they would have been. You're going to see this. It's going to be phenomenal. I'm like, you should be hearing, in spite of this chest bug I'm still getting over, that I am super, super excited. Anyway, so you can just see our debt continued to go down. Whew, that's steep. And you can, you would have heard me say, you would have heard Adam say, our debt's actually lower now than it was pre-COVID as well. So, what do you think happens as the box office gets back? All right. Want to just kind of point you, we're going to start looking forward now. So we've kind of reviewed what's behind us. Basically, the team got us through the strike, but actually did a really great job and improved the company's fundamentals. That's everything we've just talked about. Now let's turn our eyes forward. If the fundamentals are improved, when can we expect to really see the results of that? So I just want to remind you the rest of Q3. Let's just skip through the animation because most of these. So I should honestly almost like put Deadpool and Twisters on here because they still have fantastic legs. I think Deadpool is doing like, I don't know, $95 million this weekend alone, even though it's the second weekend at the domestic box office, not globally. Globally, it's even more. So you're going to see throughout the rest of the quarter, Deadpool, even Inside Out 2. Remember, they had committed to a 100-day window. I think we're only like 56 days in. Still 44 more days of Inside Out 2. We've got Twisters still going. We've got Deadpool still going. And then what I'm showing you here, and this is not even the complete list of movies, like I'm not showing It Ends With Us on here. I'm seeing people say that movie's going to be relatively big, kind of like a maybe $50-60 million movie at the domestic box office. So rest of the quarter looking really great. I kind of already tipped my hand. I think this quarter is probably anywhere from 2.4 to 2.6 billion. I used to think a little bigger, but there were some movies that moved out, like Horizon got pulled, Horizon 2 got pulled. I'm seeing on a couple movies, there's not as much buzz perhaps as I originally thought there might be. But honestly, you should just be hearing really, really fantastic quarter, like $500 million or more above last quarter. So the box office has been roaring back, setting records for animation, setting records for R-rated movies, setting records for disaster movies. I'm just referring obviously to Twister and Deadpool and Inside Out. So we're in a record-setting place while AMC was setting records on profitability. I told you about the month of June. Things are just clicking on all cylinders right now. And it's crazy because the box office isn't even back to where it's going in the future. And we're going to talk about that too. Meanwhile, in the quarter, super excited. I know you've all heard, unless you've been under a rock, that AMC is showing an Usher concert film that is distributed by AMC. So remember, we not only get the revenue for showing the movie, we get some revenue when it is shown at other exhibitors, other theaters. So love seeing AMC actually be not just an exhibitor, but a distributor. That's a lot of money for us. Really fantastic. And Adam made it clear there are more to come in Q4 and beyond. So this is part of AMC's business now that we didn't have pre-COVID. Yet another example of how we are better now than we were before. Awesome. Excited for that. Let's look at Q4. I just want to make sure you guys have heard some of the larger movies. I'm not going to by any means show the whole quarter. I'm just going to show some of the larger movies. So you've got War of the Rohirrim. That is one that I'm personally very excited. I'm a bit of a Lord of the Rings nerd. Seeing kind of anime meets Lord of the Rings, and a lot of us have probably been hungry for some content for a while. And even just to me, the hint that they'll kind of expand the Lord of the Rings universe and go beyond just sort of what I'll call the main four books, The Hobbit and the three Lord of the Rings books. Super excited for that. We know there's also a Gollum movie in the works, down the road. Would not be surprised if there starts to be more and more of that. Kind of a Middle-earth universe, maybe I'll call it. We've got Venom 3. That's coming out. Those have been real big movies, so that looks awesome. We've got the Mufasa movie. I won't be surprised if that's really, really big. I think perhaps the industry is underestimating that one, but let's see. We've got Kraven the Hunter. That one's been moved a few times. That was a strike impact, so great to see that one's coming out. Joker is going to be huge. Go back and look at how big the last one was, and that often with franchises that have done well, you see continued growth. So, and I mean, you've got Lady Gaga in that. That's a huge name, so that's going to be big. Smile 2. Smile was obviously a fantastic hit last year. I don't know, guys. I'm not always into horror movies, but boy, a lot of you are, and I think that's going to be real big. Gladiator 2, I mean, how excited can you be for, first of all, some of us absolutely loved that. I suppose I'm older than some of you, but Gladiator was really, really big. You got Denzel in this one. You got Gladiator 2, going to be huge. Denzel himself said that's like the biggest movie I think he's ever been on. His words. Sonic 3, that franchise has been growing. I think Sonic 2 was like over 200 million globally or something. I'd have to go back and look. Always dangerous to quote numbers when you don't really remember, but that one is going to be real big. Wicked obviously is huge. I mean, it's had such a big Broadway run, and now we're getting the movie. And Moana too. I mean, you've seen what Disney's franchises are doing when they bring back franchises that people love. And, with apologies to some of you if you disagree, but when you don't put ideology in there and you just make a good story that's inspiring and motivating and fun to watch and beautiful and captivating, boy, they make a lot of money. So that one I think is going to be really, really big. I'm just showing you, what is this, 10 of the movies in the quarter for Q4. So you heard Adam say on the call, he believes Q4 is going to be very big. I believe Q4 is going to be very big. So in fact, let's kind of talk. What does it look like going forward? Now, spent a lot of time in the first half of this video showing you that the fundamentals have improved and that in spite of the strike, we saw signs that things are about to get really, really good. If you know how to comb through the financials, you can see the company actually improved, in particular on the expense side, but actually really some multipliers on the revenue side too. Like food and beverage spending per person, the ticket price per person. There's some things moving in our direction. And Adam talked about how merchandise has been growing significantly, especially versus pre-COVID. It's like a $50 million business now, and continuing to grow. He thinks we can turn that into a $100 million business. I don't know if I said billion a minute ago. Hope I said million. But the team continues to grow some things. So Q3, if you've been around a while, you know how accurate my forecasts have been. So let's just hope I continue to be right. Q3, I see positive net income. So the bottom line, I see positive. I see positive cash flow. And I think Q3, so if you think back to Barbenheimer and how big that was last year, the bottom line was $12 million of earnings. We had a bottom line of about $12 million. And we were very happy, right? That was profits, that was free cash flow, it was great. I believe this quarter blows that out of the water. And by the way, that's on a lower box office. So that's going to be continued proof of what I'm saying, that this company has gotten more lean on the expense side, has created some multipliers on the revenue side. And don't sleep on popcorn revenue, right? And distribution revenue and candy revenue. It's added some things that are, in a way, not related to the box office. So they have strengthened the company on both the revenue and the expense side. This is not the same company it was in 2019. It's a far better company. We've always just been waiting for the box office. So I do believe by far this is the best bottom line of the entire retail or ape era. And it's by a lot and it won't be close. Let's hope I'm right on that. We'll see. Q4 then, again, positive bottom line, positive cash flow, and maybe then even setting yet another new best. And I've told you that's coming for a while too, that then if you roll into 2025, I bet at least 3 of those quarters, maybe all 4, but at least 3 of them, start to set new records again. And then in 2026, you're setting new records. You're going to see these next, Adam called it 6 to 30 months. I'll call it, the next 10, 10 quarters. Yeah. So we're talking about the same time period. The point is the next 2.5 years are just going to be rocking and rolling. It's going to be really, really fun to just see new best. And what you're going to watch is your management team has focused, the whole survive thing, right? They've focused on making sure we get there so that we can enjoy the party. They've basically been delivering us to the party through a really hard environment. Like you could make a movie of this, right? Just picture some movie where it's like, I don't know, a group of warriors need to deliver some child or something safely to their destination, and everybody's chasing them down. All the shorts are all these monsters that have been trying to kill us. And Adam and team have, in effect, delivered the package to its end place where it's supposed to get, and they've delivered it safely, and we're about to enjoy the party. It's going to be a lot of fun. And by the way, I think even with this Q2 having those strike impacts, if you look at the last 3 quarters combined of this year, you'll see this third bullet. I believe we probably hit positive net income on the entire combined last 9 months. What you should hear is that's almost getting to a full year of profits. Imagine we get to a place where it's not just a quarter here and a quarter there, and we start talking about full year profits. And then Wall Street's going to have to acknowledge something called the price to earnings ratio that I've talked to you about in other videos. And we start to say, whoa, this company needs to go up by 7, 8, 9, 10 times on the stock price to be fairly valued. We're going to get there. You're going to see. 2025, speaking of that, I believe we'll have full year profits, and not just a little, a lot. Full year, big profits. 2026, I'm calling it a lot, all caps. Which is the same thing Adam has been telling you. You can just see it. If you know how to read the financials, if you look at the box office of what movies are coming, how long has it been since we've had a Star Wars movie? In 2026, you start to get Star Wars. We haven't had some of the really big Marvel movies. We're starting to get a few more of those. We're starting to get the DC universe finally coming back. Kevin Feige has been working on getting that up. I might have said the wrong name there, but you guys get it. So the point is, big strike behind us, profits ahead of us, new season in life. Things are about to get to where the apes and the AMC management team are going to feel like we're the ones with all the power, and the shorts are just going to have to sit there and take it. They're going to have to find the exits. Um, Two big concepts that you're seeing in the results, and that I'd said a little bit before the call, and that Adam and team talked a lot about on the call, and that I'm going to just slowly highlight more and more because you're going to want to understand this, and it points to where we're going. And especially if you're a short listening to this and you know finances, you can see I'm right, and you better be thinking about when to find that exit. Because, and oh, by the way, this is also, so this sort of first asterisk at the top, this is the fulfillment of literally what I created this channel for. If you go all the way back, I want to say it's September of 2022 when I created this YouTube channel. I've told you guys, I've been on Twitter since the very beginning of this ride, kind of January, February 2021. I was here in December, but I had an old Twitter account that I deleted and started this stock retail account. So you'll see a February creation date on the Twitter, but been here actually since before that. But the point is, I hadn't done YouTube for a while. I jumped into YouTube at the end of 2022. And what I literally said, and I showed you, I said as a thesis, but I showed you a walkthrough of sort of, I don't know what's the word, proving out the thesis with financials that this company is better now than pre-COVID, and that we didn't have to get to pre-COVID box office to be profitable. And, I said that all the way back in September of 2022. And here we are, and you're going to start to see it. And since then, the company has done even better. So gross to net is something I want you to start knowing. Basically, if you kind of you can go from the top line to the bottom line, so revenue to bottom line, or you can also see what's the gap between this EBITDA and net income. I'm just giving you some examples. So if you went from revenue to earnings, you can go from gross to net. If you go, I said EBITDA to net income, or another one you can look at is food and beverage revenue, kind of before and after expenses. So what you're going to see is this company is managing the gross to net, which means you're getting more profitable. So for every dollar you bring in, you're keeping more of it. That's what that means. Gross is how many did you bring in, net is how many did you keep. Operating leverage, closely related. Because AMC is that fixed cost model, you're going to see, it was already going to happen. It's sort of inherent in this industry. If there's a point where there's a tipping point, whereas the box office grows, some of your expenses kind of don't need to grow anymore. Like if you have a manager at an AMC property, whether you had a $3 billion quarter at the box office or a $1 billion quarter at the box office, you had that manager. That was just kind of operating overhead, something called SG&A. But as you grow the box office, like I said, you don't suddenly need 5 managers at that property. A good manager can still manage the property. You're going to have some operating expense go up. Like if you have more showings, maybe your electric bills go up, maybe your water bill goes up, more people use the bathroom, whatever. But it's not growing as fast as the revenues are growing. So you have something called operating leverage. Go back and listen to that earnings call. Adam talked about, in some cases, we're keeping 50 to 65% of our incremental revenue because our expenses aren't growing as fast. That is a very profitable business model in an industry that is recovering. You're going to see earnings growing very, very fast. Think of it like a fast forward button or some kind of multiplier. I told you in one of the very first videos I ever made, it's like sliders in a video game, and we're going to slide towards the easy button in a way, and we're about to make a lot of profits. So TLDR, AMC is about to have accelerated profits ramp, the back half of 2024, then growing into 2025, growing again in 2026, and growing very, very fast. That's just saying what Adam's saying too, but I guess I'm just trying to underscore, that I saw that in the financials. And I'm just really pleased that these guys have led the way. So here's some things to say out loud. We're hovering around all-time highs in shares short. Profits, I pretty much provably started in June. So we're already there, right? We're here in August. June was profitable. July was profitable. And yet the shorts are living in an old world. And I've told you the algorithms are living in an old world, but not for long, guys. Not for long, because we're going to be delivering profits. We've got artists continuing to collaborate with us, some of the biggest artists you can think of. They're collaborating with AMC, and AMC's got distribution. That's more profits and more just brand name and market share. I'm keeping up a bullet I had last quarter. Popcorn's in basically like 7,000 points of distribution. Candy's ramping up. This was the first earnings call where I heard Adam and Sean directly reference profits from retail popcorn. We don't have the number yet. They're not reporting the actual number, but they talked about it as a talking point, and that's the first I've heard of them. They've talked about expansion of popcorn. They've talked about, going into different retailers like Walmart and Publix and Amazon, but I haven't heard them in the past specifically talk about the profits from it, and they did this quarter. So that is a profitable business, which, I mean, that just kind of is obvious, but it's great that it's big enough now they're starting to talk about it. We've refinanced the debt. We're no longer concerned about that 2026 debt. We have this operating leverage, so we're to the thrive part of the journey. Just say all that out loud. Shorts are hosed, guys. All right, so a couple personal notes, and then we're basically done here. Just reminding you, I told you about the strike impact all the way back last fall, or I just highlighted that clear back in 2022, I told you this company is more profitable now than pre-COVID. I predicted the angle of attacks that were going to happen in this earnings, and on Twitter at least, and on some financial websites, I saw it play out exactly like I thought it would. I warned you in some videos in kind of March and April that shorts would get you focused on the rear view. That's why I'm very thankful that Adam kind of highlighted how June was and how great that was. He was helping you see where we are now, not just where we were back in, say, April. If this quarter included April results, well, that's the strike. That's behind us. That's a one-time event. We don't need to live in that world anymore. Now here we are in June, July, August. Things are going much better. We're in a profitable business now. Cash flows are real time. That cash is coming in right now. Here today, Sunday, what is it, August 4th, people paid money to see movies in AMC today. We are not in the past. Shorts want you to live in the past, and some very bad players who, some of them, by the way, pretend they're on our team, and some of them, if you're a GameStop ape, I want you to look hard, because some of them are some of your heroes, what I call the cape wearers, who came out of the woodwork and kind of said, oh, these are terrible numbers. But now you've heard me go through, and I'm not hyping. I'm showing you the actual numbers and dissecting them through a business lens and showing you actually the numbers were really great. And from now on, we're profitable. Question why people want to point at the rearview mirror and kind of crap all over this company and crap all over this movement. And then start to say, those are not heroes. I feel strongly about this. Third point, the results are fantastic considering all the headwinds of the strike. Just showed you all of that. Point to an amazing future. It's obvious in the numbers. Adam and team are telling you, and I'm showing you in the numbers, they're not just hyping. They're actually telling you what's going to happen. I can see it in the numbers and have for a long time. So I just want you to assess who you're listening to, because today I got a bunch of DMs on Twitter about someone who I have said in the past is toxic, is no good, is not on the right team, is basically on Team Pulte. They are not with us. I got a lot of heat over that. That was probably last fall. People telling me I'm wrong, people telling me to make up with that person, people telling me to let it go. And then today, that person is out there taking shots at Adam, saying if he doesn't do X, Y, and Z, we got to get him out. Where I'm showing you the numbers, not me. The numbers show you Adam has done a fantastic job managing this company. He has led us to profits through the darkest period this industry has ever faced. And then here's someone who I told you is not on the right team, who instead of celebrating the best June ever, is out there trying to tell you, low key, if Adam doesn't do these sets of demands, that you got to get rid of him. I don't curse often, but honestly, I want to curse a lot about what that person's saying. Because guys, you're being manipulated. You're being influenced. You're being fed negativity and opinion as opposed to facts. And there's a reason on Twitter over and over I've said facts over FUD. Go back, rewind, go through this video, listen to the numbers. I know numbers are not an awesome video. I get way less clicks on these videos. But if you want to beat the FUD and you want to see who's actually on the right team, I've said over and over, you need to listen to voices of two things: integrity and credibility. And they have to have both, because you can be an honest person who knows nothing, and you can be someone who knows what you're talking about. That's the credibility, but you lie. You need to listen to voices who have integrity and who consistently get things right. That's all I'm going to say about that, but I'm just telling you, this is the biggest play maybe ever. I don't know. I'm going to be polite to GameStop apes and say, obviously, you are involved in a massive, massive play. So let's put them together. That's fine. But certainly, the amount of online manipulation, everything I've shown you in the past with the Stokens with AMC, the amount of television and news media attacks, the amount of false apes. Guys, there's people who stand to lose everything they've built. Their kingdoms are getting torn down. Don't sleep on the fact that they would love to sway your sentiment. So come back to facts, come back to DD, come back to conviction, look at the numbers, and if a voice is telling you something that doesn't line up with the numbers, then either that person does not have integrity or does not have credibility or perhaps even lacks both. All right, enough about that, because the main thing is we will win. Let's go.